the mid-cap space, we have here that Kotak Emerging Equity fund, which is also given a close to a 20% CAGR. And just to throw in some numbers, a 5,000 rupee SIP at 12% over a period of 20 years would grow to around, you can say, 50 lakh rupees. Compared to that, if you are looking at a 5,000 rupee SIP at 17% per annum, which is a 5% more per annum, that is growing to a corpus of 1 crore rupees. So, that extra 5% per annum alpha over a period of 20 years translates to almost translates to double amount of corpus over a period of 20 years. So, though even if he's a medium risk appetite, then he can maybe look like a multi cap or a flexi cap fund. But I would suggest more to go for a small cap or a mid cap fund.
Okay, you can definitely play around in the small and mid cap if you do have such a large time horizon and take advantage of that. Helpful advice there. The next query comes in from Vishal Kumar, who's written in from New Delhi. He is asking about, considering the fact that we're seeing this volatility in the market, he asks if he should maybe shift his portfolio to include some amount of flexi cap mutual funds as well. Gaurav, you think this is a good option?
What is his current portfolio? Is he having large cap? Because in the question is not mentioned that whether he's having large cap or small cap or mid cap.
I know that was a question I had as well. So we don't actually know his current portfolio. So maybe you could just suggest some flexi cap funds which you think are perhaps good to get into. And when do you think an investor should look at a flexi cap fund? Who is it correct for? That would, I'm sure, help our viewer as well.
My top pick would be the Parag Parekh Flexi Cap Fund. That's been, it's going to complete, in fact, 10 years on the 25th May 2023. It's almost having a 18% CAGR return for the last 10 years. It's giving also overseas exposure of about 10 to 15% through, investments in Alphabet, Microsoft, and they are having small exposure in Facebook as well, but which is your Meta. But overall, that fund has delivered returns across all time frames, and even HDFC Flexi Cap can be considered. Even with Prashant Jain leaving, Ms. Roshni Jain is managing the fund, and it seems to have given a consistent return over a period of time.
Okay, all right. So those are the two picks as far as flexi cap category is concerned. And this is something we need to discuss also, Pavitra, right? Yeah. This is a category which has been getting a lot of interest. So whether that works, what doesn't work, we'll discuss that in greater detail in some other show. But for now, we'll slip into a short break. And on the other side, we'll continue our discussion with Gaurav Gupta of G Cube Investments and get all your mutual fund related queries. Stay tuned for that.
Welcome back. You're still tuned into MF Corner here on CNBC TV18, and we still have Gaurav Gupta of G-Cube Investments to answer all of your queries. We're addressing a lot of individual queries that have come through to us on our portal, so we're going to really address them. Gaurav, the next query is from Mayank Gupta. He writes in from Indore, and he says he wants to know if it is a good bet to invest in small cap funds compared to other categories, and looking at the volatility in the market. I know in some part you've already answered this, but take us through a good small cap fund that you could invest in right now.
Yeah, so my top pick would be the Nippon Small Cap Fund. The reason why I'm suggesting this fund also is that it's got maybe a 13-14 year track record now. The 10-year CAGR of the fund is around 25%. Secondly, the fund is having a portfolio of around 120 to 130 stocks. This you usually do not see in a small cap fund, because the fund AUM is close to 25,000 crores now. So what they've done is that they haven't kept more than 1.5-2% exposure to any single stock. So usually what happens in a small cap fund, if you're having a larger weightage to a single stock, then there could be a liquidity issue due to, in case the company is not doing well and the fund manager wants to sell the stock in the portfolio. So with the 120 stock portfolio, and Mr. Samir Raj has been managing this fund for the last 6-7 years, and I think he's done an excellent job. And Nippon as a mutual fund has now, in the last couple of years, again, the equity funds, most of them are on the top quartile. So definitely Nippon Small Cap Fund would be, the fund I would be recommending for him.
Okay, we get that point. Nippon India Small Cap Fund is your take here, or your preference as far as small cap investing is concerned. Let's move on to the next query. Rohit Jain writes to us from New Delhi. He wants to start a children's education fund for his 5-year-old. He wants to know if he should look at via SIP, or is it even too early to think about your child education plans. I think I would assume that it's a great start that Rohit is making. Gaurav, what would your suggestion be? How should he go about planning his child's future and especially education plans here?
I would say it's great that he's looking at starting, so early, since his child was 5 years old. And the earlier you start a SIP, obviously the better it is. And, he can benefit from, the compounding effect if he holds it for that 15, 20-year period. And also what we are seeing is that the cost of, education is increasing every year due to, inflation. So, investing in SIPs would help him, fight inflation and help him to, develop a substantial corpus for his child, maybe when he turns maybe 18 or 20. And maybe depending on the amount he's looking at investing, if he's, looking at private education or for sending his son abroad, he can, consider investment. Depending on his risk profile, and, I'm not sure exactly, what his risk appetite is, but, taking a medium sort of risk in mind, I would suggest that he can go on for a large cap, a flexi cap, a mid cap, and a small cap. Broadly, these 4 categories are the, funds that, the SIP can be divided into. On the large cap side, it would be the SBI Blue Chip Fund. On the flexi cap, like he can select a HDFC flexi cap. And in the mid cap, the Kotak Emerging, and in the small cap, like I said earlier, the Nippon India Small Cap.
Okay, that is very useful. And, like you mentioned as well, never too early to start with your investment. So if he's considering looking at this when his child is just 5 years old, it's even better perhaps than, waiting a couple of years. The next query comes in from Shweta Srivastava. She writes in from Chandigarh, and she says she can invest around 10,000 rupees every month for the long term, or, even for at least 20 years she's looking at. So she's looking at 10,000 rupees per month for a 20-year period. She says that she's a medium to high risk kind of investor. She's willing to take on some amount of risk, and she wants to know what is the kind of corpus that she can generate if she does put in 10,000 rupees per month, and also what schemes she should look at. I think you've taken us through some schemes that would be good from a longer term perspective, but she's asking what is the corpus she can look at if she puts in 10,000 rupees per month for a 20-year period.
So the 10,000 rupee per month at 17% per annum for 20 years would generate around a 2 crore rupee corpus. And similarly, that same 10,000 at a 12% per annum for 20 years would generate a 1 crore rupee corpus. So that's why I said that, if the time horizon is longer, definitely the allocation to, the mid and small cap can be maybe out of that 10,000 rupees, around 6,000 rupees, 3,000, say in a mid cap and a small cap fund, and the balance to 2,000 rupees can be put maybe into a flexi cap and a multi cap sort of fund.
Okay, all right. So that's the kind of split Shweta should look at with the corpus that she has and what she is willing to invest as well. Let's get to our next query now. Kusum Lata is writing to us from Mumbai. She says she's been reading about the opportunity in dividend yield funds. SBI also recently launched their fund. She asked if it is a good space to be in, considering that PSU stocks have been rallying. In that case, Gaurav, what would your sense be? Because dividend yields would be higher if the stocks are on the lower side, but these stocks have been doing well so far. What's your sense at current levels and current valuations and dividend payouts as well?
Dividend yield is always, I would say, a good allocation. It should be 5 to 10% of your overall portfolio. Say if you're investing 100 rupees and 30% exposure you're giving to a large cap fund, you can consider out of the large cap portion to put about 5 to 10% of the portfolio of your large cap allocation into this dividend yield category, because most of the dividend yield funds, most of the dividend yield stocks are large cap oriented stocks. So even though, like you rightly said, there has been, a PSU rally that has happened and a lot of companies have declared, high dividends. But going forward, I think this category can be, more for risk averse investors, because what happens when usually markets fall, these dividend yield funds or dividend yield stocks, they fall less than the market. The beta is much less than the market fall.
Okay, so that is on dividend yield funds. This space has also been garnering a lot of attention. Like Sonal was mentioning, the dividend yield fund by SBI also just came out and it managed to see a lot of inflows during its NFO as well. So it's definitely a space that has become a little bit more popular. But the next query comes in from Jaspal Singh, who's written in from Amritsar. He says that he's looking at some amount of debt exposure and he asks which schemes he should pick and the categories as well, because within that debt there are so many different categories you could look at. He's once again looking at a long time horizon. 10 years is what he's looking at. So Gaurav, with the 10-year time frame, you want to give us 2 or 3 debt funds that would be a good pick?
Yeah, again, there is a Bharat bond ETF, so which is by Edelweiss, the Bharat bond. So they are investing in 10-year PSU bonds. Fund which for September 32 maturity. Similarly, a Nippon target Nifty GSEC fund that's having a 2036. So these are all between the 10 to 13 year bracket where he can look at investing. He can also consider investing now some money into fixed deposits with this tax implication change that has happened towards the end of March. So, you can divide it between maybe these Bharat bond and these target maturity funds and some money towards fixed deposits as well.
Okay, all right. So this is about Jaspal's query, what he can do with the funds he has and the investment plans that he has as well. Shruti Arora is writing to us from Bihar. She asks, following the recent death tax amendments, what is the best inflation beating tool available now which can also take care of long-term goals such as retirement? Gaurav, your take here?
See, now what has happened with the recent tax implications, even a fixed deposit is yielding 8% or a target maturity fund is giving between 7 to 8%. Now with a 30% tax bracket, your net tax return is coming to around 5.5%. In today's inflationary scenario, the inflation is bare minimum around 6 to 7%. So I would say that, it's not covering, the debt is not covering the cost of inflation. So he would have to look at some equity exposure, with this, change in tax that has happened. And the way to do that would be either to invest through equity mutual funds if he's having a 7 to 10 year horizon, or if he's a little bit moderate risk investor and having a slightly shorter horizon, he can look at the balance advantage funds, which invest about 30 to 65% in equity and the balance in debt.
All right, we got that, and that is some good advice on how you should, try and get some amount of debt exposure. Gaurav, we're going to wind down on that note, but thank you as always, for taking us through all of our queries and helping our individual viewers to sort of really address what their concerns are. But thanks a lot for that. On that note, we're going to wind down on this edition of MF Corner. You stay tuned because closing bell comes up after this very short break to take you through the final hour of trade.